Hi everyone. Hi Jonathan.
Hi,
Sabrine.
Cedric.
Adana.
Hi, everyone.
Great,
Hello.
perfect.
Hi.
Great. So
Good.
we have everyone. Yeah, Jonathan, please start.
Yes, as always, just let us know in the comment section where you're joining us from. We want to engage with you and we can get started. Go 59 seconds maximum.
Perfect. I don't see I'm sharing my screen, so can you tell me uh, where is the audience from?
Yeah, not got any comment yet.
Okay.
I mean, the audience is quiet today. Like, we have close to 40 people that is already in the room. And go head over to the comment
Okay.
sections and just let us know where you're joining us from.
Okay, perfect. Otherwise, we can start and you will let us know, Jonathan.
Oh,
So, perfect. Thank you so much, everyone, for having joined this second webinar of the Human Planet Accelerator launch. For this new cohort. We are very happy today. So I was already here yesterday, but today I'm joined by Sabrine Rahman, who is partner at Human Planet. I'm very happy to have you, Sabrine, today with us. We will walk the audience through innovative finance today. Yesterday, we focused quite a lot on fundraising, what are the best practice, and we are moving to a bit more technical today. We have also two amazing speakers today, and we are very happy to have Adana Shukruma, who is Associate Vice President for Economic Growth at CARE USA, and also Rui Barros, who is an impact investor and entrepreneur through several companies, including Gen Alpha and Dual Dune. We will introduce our speakers later on, and we'll have time to exchange. Quickly, what we um, mentioned yesterday and to do the transition. So as I mentioned, we focused quite a lot on fundraising and how we fundraise. And what we wanted to share yesterday is that a few takeaways. The first one is that impact finance is something which is real. We did show the numbers. It's something which is actually an expanding market, even if grants are more being downside these days. We also explained a bit how we can move from grants to investments, meaning moving from models which are fully relying on philanthropy to something which are more around blended finance and innovative finance tools, more towards impact finance. We also shared what are the key things for investors and also around funding diversification. So today we will mostly move away from fundraising and try to get into a slightly more technical on the different innovative finance tools and the innovative finance landscape. The same as yesterday, we'll start with 20 minutes where Sabrine and myself will share our insights around innovative finance. And after this, we will have our two great speakers today to share their experience, and we have a few questions for them. And we will finish with the Q&A, for the last 20 minutes for the audience to be able to ask questions. We had great questions yesterday, so we hope it will be same today. Quickly, before we start, who we are. So Human Planet, we are an impact finance firm which is actually supporting NGOs, startups, organizations, corporates, any organization who has initiatives with positive impact, environmental and social impact. And what we do every day is that we are the link between the impactful projects or initiatives and the funders, be it investors, be it philanthropists, family offices, funds, and we actually design and engineer financial solutions to bridge a gap between the impact on the ground and the investors on the financial markets. We already shared yesterday, so I won't go into detail our ecosystem, but what is unique about us because we are working on impact finance, we actually have a diversified ecosystem, NGOs, startups, implementers on the ground delivering impact, but also within the financial markets, like the banks, family offices, the philanthropists, a lot of different ecosystems, and we try to bring everyone together. Today, we are actually launching a new cohort for the Human Planet Accelerator. We innovated a bit this time. There are three thematics, but the goal is still the same. It's to be able to support NGOs, project developers, startups, social enterprises to be able to diversify their access to funding and to strengthen their approach for fundraising typically. So we have a scale-up program, which is more for advanced organizations where they can actually fundraise, but we have a journey to help them to design the right programs and the right tools and get access to the right investors. And what is new for this time, we included the incubator program, which is more a light touch coaching program, where we actually support with the same spirit to help you and to guide you through the fundraising journey. And after, we also have a third component, which are the webinar series, which are more like a learning pathway for anyone who wants to know more about innovative finance, a series of webinar. So I will actually stop here. Before I give the floor to Sabrine, we actually give you the opportunity to book consultations or a meeting with us, with the team, so you can actually know a bit more about the accelerator, share your project or what you want to do. We give you feedback very happily. And also, if it's a good fit for the accelerator, we can move to the next steps. Or even if you want to connect, to get feedback, happy to do it. This is a link for the consultations, the QR code, so you can do it. It will go directly to my calendar. And after, within the team, we actually share it between the team. I had two calls this morning with great organizations. So it's very, very interesting to see. Always impressed by what we see on the ground. And the QR code for applications, if you want to apply, it's also on our website. It's also something we can share if you book a consultation. So I won't be longer than I should be. And actually, we have two questions for you, for the audience, before I give the floor to Sabrine. I think the first one is actually to know you a bit better. The first one related to your model today in terms of financing model. So do you rely on grants, A, only on grants, or mix of grants and income, B, C, impact investment, or D, are you already like masters of innovative finance and already have done 7 impact bonds, for instance? Happy to know more. Jonathan, do we have some answers?
Yes, it's pulled in. We have 31 submit already.
Okay,
And we have, yeah, it's pulled in. Let's give it 59 seconds. Share the results.
perfect. Okay. Um, okay, we'll see how many Ds we have, actually. It's always interesting. And actually, we had some, even this morning, some very advanced, potential cohort members, so very impressed by what people are able to do on the ground, being very focused on delivering impact, but also innovating on the financing side. Very interesting. Perfect. So, Jonathan, can we share the results?
Yes, for the first question, we have traditional grant only, that's 38%. And for grant and
38.
earned income, we have 36%.
Okay.
36%. First one is 38, it's just increase. We have exploring impact investment, we have at 21%, and we have already using innovative finance, we only have only 6% of the community.
Okay, which is already nice. So for anyone who has done innovative finance, feel free to write in the chat if you want to share your experience. And it's great actually to see the grants and income, which is also significant. So it's great to know it. So yes. So the second question: which innovative finance instruments interest you the most? It will be very useful also for Sabrine, who will present some of the tools. Usually, I don't know why impact bonds is like the thing that is everyone wants to know more. Um, but yeah, so it's either impact bonds, blended finance. To remind everyone, blended finance, you mix grants and commercial investment. C, result-based or outcome-based finance. And D, impact funds or pooled vehicles. Um, so we will see the results. Yeah, I think impact bonds is usually the thing that people want to know, but we will see if I'm wrong. Jonathan, you have some results?
Yes, the results are put in.
Okay, and I see the number of participants growing. I see some questions in the chat as well. Great. So yeah, we'll have the Q&A session
Uh,
after. So don't hesitate to
Cedric, I
write your
think
questions. Yeah, Jonathan.
your projection was quite wrong. We have
Thanks.
58% blended finance structure. I would have only
Is blended
16%
finance?
for impact bonds. Yeah.
Okay. Okay, I should not have said impact bonds at the beginning. That's why. But yeah, no, very interesting. So it's great for you, Sabrine, actually, to know. And I will give you the floor, Sabrine, for the next phase. Let's deep dive. Yeah. Thanks.
Wonderful. Thank you, everyone. Thank you for your time, and thank you for your enthusiasm in giving us your sort of insights so far. As Cedric said, I'm one of the partners here at Human Planet, and my background has been almost 20 years in sustainable finance, as well as international climate policy. So it's an incredible journey for me to be here with the team. And what we wanted to do today is take you through the changing landscape of innovative finance. So, as Cedric very articulately said, we as an organization sit at this very unique intersection of the impact investment world, where we understand the realities that many of you face, NGOs, social enterprises, impact driven organizations, but also what investors are looking for. And that dual perspective is really what sets us apart. And we understand that impact driven organizations are often caught between the ambition of their mission and the constraints of traditional funding cycles. And we hope that we can help, bring our expertise to help bridge that gap. So, as you can see from this slide, there is a steady and growing landscape of innovations in finance. But also, what you can also see is that there's significant funding available that is already being mobilized utilizing these instruments. So, these aren't new. They're trusted, they're being deployed, and there is funding to be attracted to it. So, in particular, today we're going to go through briefly 4 instrument families: impact bonds, outcome-based finance, blended finance, and impact funds. So I'm hoping with the poll results, we'll be able to cover everyone's requests. But as Cedric said, please do get in touch with us if you need more of a deep dive. That's what we're here for on a one-to-one basis. So each of these instrument families have a very unique approach and design. And depending on the investment and impact thesis, they can be tweaked for maximum benefit to investors and the mission of the organization. If we move to the next slide, just so we can start now going into the actual instruments. So we all know the world is changing very rapidly. For a long time, the investment world, the world that I knew very well, operated on a very simple principle: maximize financial return. That's it. Social, environmental outcomes were really not a primary issue. And it's something that governments or charities or the nonprofit world were tasked of delivering. But we all know that that has significantly shifted over the last decade, and that shift is accelerating. I think in earlier slides yesterday, Cedric also did present that the scale of the problems that we're facing are too great. A $4 trillion deficit in helping meet some of the requirements of the SDGs. Governments are stretched, irrespective of which market you're in. Aid budgets are under pressure. And even traditional philanthropy, as generous and effective as it has been, investors, therefore, are looking at that number and realizing that the world's biggest challenges are going to be, if we are going to address it systematically, private capital has to play a role. And that's where innovative finance really comes in. The risk return story is really changing. So one of the biggest barriers for investors has always been the perceived risk, right? So emerging markets, social programs, environmental projects, they were seen as high risk when you go through the credit risk assessment process, and often low return. But blended finance structures have started changing that calculation. So when catalytic capital from foundations or governments absorbs the first layer of risk, it makes these investments genuinely viable for institutional or commercial investors who have fiduciary duties to their clients. And it starts looking a lot more attractive. We've also seen over the last decade, particularly regulation and reporting requirements are helping push that agenda. So these are some of the macro drivers, right? So investors, particularly large institutional ones, are being pushed by external forces. ESG regulation, for example, in Europe, tightening was a great push. Pension funds, asset managers, who are also under increasing pressure from their own clients and beneficiaries, as well as regulators, to demonstrate that their portfolios were reflecting responsible values and doing no harm. So those are two very, very important things to remember. And investing in innovative finance gives them a credible and a measurable way to do that. So it's not just about the label, it's the structure that has outcomes already baked into it. So these are what investors are really starting to, the reason why investors are interested. And then another thing to really remember, that there's a huge intergenerational shift happening. We're seeing younger and younger investors coming in, and wealth holders and wealth transfer happening. They're asking questions that were perhaps never asked. These are from private family offices, family foundations. They want to know what their capital is doing in the world, not just what return it's generating. Impact investment, outcome-based finance, blended structures, they speak directly to that expectation. So any wealth manager or fund houses that offer innovative finance products, they are becoming increasingly more competitive and are attracting a lot more business. So if we move to the next slide, we'll start going into a little bit more detail. Great, thank you. So I know there are a few questions on how blended finance works holistically. So we'll keep it high level today, but blended finance is really a structuring approach that strategically combines different types of capital to unlock investment in markets or communities that would otherwise be too risky for mainstream investors, which is what I touched upon earlier. So at its core, the model relies on catalytic capital, often provided by philanthropies, development finance institutions, or governments. And these are institutions that are part of Human Planet's broader ecosystem that Cedric pointed to earlier. And then this capital is usually deployed first, and it absorbs a higher degree of risk, or it also accepts below market returns. So once that is done, it starts making the deal very attractive to other capital providers, particularly commercial capital providers. So private investors, institutional funds, banks, who require more predictability, market rate returns, but who in a very different world would not have participated in such a deal if that protective cushioning wasn't provided. So that's the kind of innovation that we bring, really layering these capital types together and really ensuring that catalytic capital takes that risk, first loss position, commercial capital comes in a more protected position within the capital stack. And then we can really mobilize significantly more resources and funding, more than grant-based philanthropy ever could. And also something to really to really focus on is that it's not capital that we're deploying without any accountability. Impact outcomes are actually built into the design of these transactions from the start. And that's the partnership model that we have. Metrics are tracked throughout the investment lifecycle to ensure that financial returns, social, environmental results are being achieved in tandem. And the goal is really to provide these impact-driven metrics into the market and really showcase that markets can perform, and therefore creating a virtuous cycle where more and more commercial capital over time will be attracted to such projects. So I will move on to the next type, which is impact bonds. And again, there was a few questions about that. So I'm glad we've chosen to focus a little on that. So what is an impact bond? An impact bond is a performance-based financing mechanism, and it really focuses on three main players. And here we've provided a process map, but the three key players I wanted to focus on is investors, service providers, and outcome funders. And the capital, the way it flows is investors, often philanthropists, foundations, or socially motivated funds, provide the upfront capital required, particularly to a nonprofit or a social enterprise, to deliver a program that targets a specified outcome, whether, for example, employment, addressing unemployment rates, or improved health outcomes, and so on. And then we have an independent evaluator who also measures those agreed upon outcomes are actually achieved. Now, if the outcome funder, who is typically a government agency or a foundation, reimburses the investors, then the original capital plus return is delivered, right? And often that delivery is actually tied to the impact achieved. So if the outcomes aren't met, the independently verified outcomes, if they're not met, the outcome funder pays nothing, meaning that the financial risk sits with the investors rather than the public or the service provider. And what makes this model really powerful, in a nutshell, is that it aligns everyone's incentives around results. So investors are motivated to support effective programs, which I know many of you are running. Service providers have the flexible patient capital that they need to innovate, because we know grant funding cycles often prohibit real innovation from happening. And outcome funders only pay for what actually works. So those levels of accountability align all stakeholder groups to do the best that they can do, but also there's hyper transparency at every step of the game. If we move to the next slide, what we wanted to showcase very simply here is really what outcome-based financing versus results-based finance looks like. So most of you will be familiar with the traditional grant model, where a donor or government agency gives you a grant or a contract and you deliver a set of activities, whether it's a training program, a health clinic, a community workshop, and you report back on what you delivered. The funding is tied to inputs and outputs. Did you run the program? Did you reach the target number of beneficiaries? That's traditional funding, and it has served the sector well for many decades. But I guess that's the real crux of our webinar series. It funds activity and not necessarily change. But if we start looking at things like results-based finance, we're starting to shift that question from what did you do to what changed because of what you did. Funding is tied, at least some part of it, whether or not measurable results are achieved. And this could mean that the funder pays more if a certain percentage of participants gain employment, for example, or they will release tranches of additional funding if one or more specific milestones in your program are met. But what it does is it creates a stronger link between money and meaningful change, but it also puts more pressure on organizations to measure and evidence their impact rigorously. And outcomes-based finance actually takes that one step further. So outcomes-based finance, which includes models like social impact bonds or development impact bonds, really starts delving a bit deeper. So here, outcomes are agreed upfront, independently verified, payment is triggered only when they're achieved. And the organization often receives upfront capital from investors to deliver that work. And a separate outcome funder, such as a government or foundation, pays back those investors if the results are delivered. And for NGOs, that can feel like a significant shift. You're no longer just held accountable to a donor for activities. You're accountable to evidence standard, and your funding will depend on it. Look, at the end of the day, there's no right model for everyone or for anyone, and it has to be done through a diagnostic approach. And many of these structures, in full transparency, will require strong data systems, the ability to manage financial risk, and time to negotiate complex contracts. And that's what we do. But for many organizations that I've worked with in the past, they have proven programs, they have the capacity to evidence impact. They just need some help to open the doors to new pools of capital. And that's what we hope that the next two speakers will be able to take you through in terms of their lens and their experiences. So I will pause there and invite them on. Cedric, should I hand over to you?
Yeah, just before we start for the speakers, just wanted to share one more time the two QR codes for registration. So this one is for consultations. If someone from the audience, any organizations want to book consultations, first of all, we'll give you feedback, or if you have any questions on the innovative finance and want to have some advice, we will do it. We'll also take the opportunity for to see if your projects are a good fit for the accelerator. So we highly recommend to book a consultations. It's at no cost, of course. And after the application for the Human Planet Accelerator, this is the QR code. It's also on our website. And yeah, so we can move on to the questions for our two speakers. Sabrine, do you want to start? And maybe, yeah, sure.
Happy to. So we'll start off with Rui Barros. So Rui, are you there?
Yes, I'm here. Hello, everyone. Sabrine.
Wonderful. Thank you so much for joining. So just for everyone's, just a reminder. So Rui is a dear friend and a long-time impact investor. And he represents several organizations, Gen Alpha, Dual Dune, as Cedric mentioned. But he's also had a significant and distinguished career in finance, working in institutions such as Barclays, Standard Chartered, and Lehman Brothers. He sits on the board of several VC funds and impact investment funds and is a member of YPO. So Rui has very kindly agreed to join us today to share some of his insights. So I will kick off, if you don't mind, Rui. I'm going to start with your first question. So you've spent over 2 decades in institutional finance, and now you're an impact investor. So what made you pivot? What do traditional finance professionals misunderstand about impact investment?
Well, thank you, Sabrine. Well, first of all, I must say, I started as an impact investor, as most people, I would say, gradually. So I looked at it from a personal perspective. I started changing my personal allocation and being concerned about how my money was being directed, be it in the plain vanilla kind of investments or savings we do, or some more sophisticated approach. So I was working, as you mentioned, I worked for several large banks around the world, but at a personal level, I start getting that, coming more and more to my consideration and trying to align my personal allocation, family allocation, with my principles and purpose. So I think that was my trajectory. And then, of course, at some point, I felt like I wanted to use 100% of my resources, of my time, my energy, my knowledge, my network, to put at work those skills that I gained working in the industry. So obviously there's knowledge, there's skills and network, but applied exclusively into this space of impact investing and sustainability in general. So that's kind of the second life that I'm living today. Just on the question around what traditional financial services miss out of impact investing. To be honest, I don't think that they miss it or they don't understand. It is a choice. And I think most people working in the industry fully understand the differences. What I would say, and maybe we can explore a little bit more, is that impact investing or a sustainable business, it's all about the how and not the what. So traditional finance basically supports financially businesses that have similar end games to impact investing, but the how is completely different. And I would say there's an extra layer when we look at it from an impact perspective.
Fantastic. No, I think that's really helpful. I mean, would you mind if we then moved around some of your questions? Because I think if we jump to one of the questions that we had is that many of the people on the call, the NGOs, the impact driven organizations are exploring revenue generating models, right, for the first time. And you were talking about it's not the what, it's the how. So what are top 2 or 3 things that an investor such as yourself would look for when evaluating early stage sort of projects, and what would define success on sort of measuring the how?
Well, first of all, I want to note that, and Andy, you and Cedric mentioned that earlier on, there's an amazing evolution in this space, probably even more so around social enterprise than environmental, because obviously I think there's more capital allocation going into environmental in the earlier stage. But all of it now, I think, has evolved into a much more sophisticated level, which is great. And obviously, we're starting to see solutions like blended finance coming in and becoming, more and more common. That said, what I would say is quite important when we look at it is, how. So there's 2 main things actually. One, and I'll start with a kind of simpler one, is quality of the delivery. How to measure the impact, how to report that impact, being very laser focused about what is that we want to deliver and how we measure it, because that is, the kind of the groundwork that offers the trust that investors look for, basically the historical data, but of course, once there's an investment in place, how to track it. Impact investors do look for that kind of reward. They do want to have tangible outcomes of, what am I being enabling in terms of change in the world. So the quality of the impact and of the reporting of such impact, I think it's quite important. And sometimes, it's neglected, or at least not considered so much as I think it should. But when we look specifically to revenue generation, what I've seen that it's really crucial is to make sure that for each one's cause, we identify who's the ultimate beneficiary, and making sure that the business model, and I want to underline that has to be a business. It's even if you're an NGO. That path means that you need to generate revenue, so there's got to be a business model supporting it. And identifying who's the ultimate beneficiary is crucial. And I'll give a couple of examples that I think maybe help understanding. One, that I'm actually an investor in a startup that is growing quite fast in that space, is in education. And they basically found a model where large corporates pay for the educational work they're doing, because these corporates recognize that the marketplace requires better education in the countries that they operate, and the public system is not able to deliver at the level they expect. And it's quite important that these are elementary, secondary education. So it's not that the same individuals that are being financed are the ones that these corporates end up employing. They actually investing in the society, knowing that ultimately that result will come their way. And that, I think, that's quite an interesting way to approach it. You want to invest in education, but someone is benefiting it. So that is where you're going to find the revenues. So you can then raise funds, because you don't have like a contractual off-taker, but you do have, let's call it, sponsors that are willing to pay for the outcomes of your educational project. A similar one would be the insurance industry. I think in the last few years, we've seen quite a few of that. Changes in behavior in consumers that lower the risk profile of population in general end up benefiting insurance companies by lowering their risk profile. So there might be an opportunity to generate revenues to actually have insurance companies as sponsors for some kind of social or environmental work we're doing, and therefore, raising funds in the first instance, piggybacking on what those revenues can be in the future. So I think those would be certainly quite a two big ones to focus on, in my opinion.
Yeah, thanks, Rory. So essentially, what makes a venture or an entity fundable is really that solid business case, right? Where their mission is really being supplemented by hard-nosed commercials that will also allow it to scale effectively in some shape or form. I wanted to also talk a little about your role in Gen Alpha and your broader advisory roles, right? You've obviously got a lot of experience. I would love to know from your perspective, what is the most promising blended finance structure that you've seen work in practice? Because we are talking about different structures today. I'd love to hear some of your thoughts on that.
Yeah, sure. Well, first of all, I must say, Gen Alpha in particular is focused more on institutional impact investing. So we tend to work with large institutional players, pension funds, DFIs, etc., in shifting capital allocation. So back to your first question, how can we convince capital, wherever it sits, to move from traditional finance into impact investing, to consider more the how than just the what, to use the expressions I've applied before. And the one trend that I would highlight in that space is, and it talks to your presentation when you were showing that slide on blended finance and the trenching that I think you represented with, a junior tranche, which will be the catalytic money, and then, mezz and senior tranches, to try and bring in different layers of risk appetite, obviously paired with equivalent returns into one structure. And in fact, what we've been seeing is that, and that is something that was for many years and still is used in, for instance, financial services financing models through securitization and trenching in their fixed income structures. And what we've been seeing is that actually the blended structures are now being more quicker in terms of recycling that first loss piece. So the junior tranche that the patient capital may bring in precisely through securitization. As projects start having some proof points, sometimes these investors, DFIs for instance, do not stay until the end of the project because they are able to pass on their positions in secondary markets to more commercial investors who now see the risk return matching their own profile. And that talks also, I think one of you were mentioning earlier in the presentation, that in fact, there's been quite an impact in the last 24 months, I would say, in terms of funding that has been made available to DFIs, donors, philanthropies, etc. So this is quite an important feature in the industry because it just allows the same money to recycle quicker and fund new projects. Yep. So I think that's quite an interesting one, and I would strongly advise whomever is looking into blended finance transactions to consider that as part of the structure, because it's also a very important incentive these days for DFIs to consider investing, as they may see their tenure shortened based on some milestones being achieved.
Thanks, Roy. That's incredibly helpful. Last question before we go to Adana. If you had to explain to an NGO leader in 1 minute why innovative finance matters for their mission, right? What would you say? What is your pitch, Roy?
Well, hopefully what we said so far would have been good enough, but it's not a minute. Well, to be honest, I mentioned earlier, some of this technology, if it can call so, has been used before, and has been used, in the most sophisticated parts of the finance world. So if it has worked for them, if it made sense to be there for such a long time, why not using for the most important causes we have in the world, which are our people and our planet? So I see this movement as kind of a democratization of innovative finance as we knew it. And we must claim it, to be honest, because this time around it's going to be used for the better purposes that we have.
That was compelling. Thank you. We must claim it. I'm going to remember that. Thanks, Roy. Cedric, I will hand over to you to now take us through some questions with Adana.
Yeah, thank you so much, and thanks, Roy, for all these insights. It's great to have the view from investors and see how you actually try to find the right fit between impact and capital allocation, because it's all about intent and trying to to do things with purpose. So thanks again, and I'm very happy to be with Adana also to share some insight as well. So Adana, very briefly, before we deep dive in the questions, you are Associate Vice President for Economic Growth and Private Sector Engagement at CARE USA. We have actually at Human Planet worked with CARE, which is an amazing humanitarian organization everyone knows already. And actually, it's great to have you because with your position and your work, you're actually very well exposed and in the center of the topic today. So thank you so much for joining us today, having joined us.
Thank you, Cedric.
And actually, I will start with the first question, which is actually related to these points, because at CARE you have actually evolved and you are quite advanced into not only relying on on grant funding, but diversifying and getting more exposure with private sector engagement and private resource mobilization. So maybe if you could share your view and how your organization has been approaching this opportunity and challenge at the same time, actually.
Right. Well, thanks. It's very nice to be here. CARE's exploration of this space has been very varied, right, over the years. So the range is we have actually spun off a debt fund. A $2 billion debt fund invests in microfinance institutions that we still hold equity in. We have attempted to raise an investment, a fund that was supposed to hold debt and equity with SheTrades. We closed without raising the amounts that we had planned to. It stretched our institutional capabilities. And then across the Federation, after these two experiences with funds, we have a litany of project-based blended finance, initiatives, right? So everything ranging from, us, implementing guarantees, interest rate buy downs, wholesale credit, development impact bonds. And then to add to that, in my role, I have started building out and normalizing our ability to develop contractual engagements with supply chains of corporations where we get paid for delivering an investable pipeline of micro enterprises. So that's the range, right? When people think about CARE, the two things that come to mind. One is our CARE Shares package, right? The thing we're known for, World War II delivering packages. The second thing is the savings group, right? The team I lead, the whole savings group core reports to me, right? So we've started, apparently CARE has started 40% of savings groups in the world, 30 million people in the savings groups we lead. And now where I'm trying to take care is that savings group pipeline becoming a pipeline for micro enterprises because of the work we have layered on top of it, right? So how am I trying to get us there? And I think that's what is key for our entry point into conversations in blended finance. I'll give some examples maybe, as we talk, is over time, we have systematized, because what happens in a savings group? We have 15, 20, 25 people who start meeting together. They learn how to save, borrow, invest collectively, and they keep records, right? So that's what, in the beginning, the intent was subsistence. And then over time, we started layering in things like, the small crop of people who want to start businesses. How do you, develop a business plan? How do you do business financial management? And then we layered in critically digitization. So then their transaction record, saving, borrowing, repaying, investing becomes auditable, becomes verifiable. And we've layered on top of that alternative credit scoring with the evolution of fintechs and looking for patterns in that data that predicts, credit worthiness. And then connections to microfinance institutions, to digital credits, to things like that. That now became the entry point for a capital access, connecting to commercial investors, connecting to banks. And often CARE is in stacks where the bottom layer, I talk about our TA as catalytic. The bottom layer is us. We are grant finance, and we are doing origination, we are doing aggregation, we are doing digitization, we are doing enterprise readiness. The next layer up, we are doing mostly grant finance, catalytic sort of capital tools or blended finance tools. So it's things like interest rate buy downs, partial credit guarantees, first loss layers. The next layer up usually is an investor of sorts, right? So there's some philanthropy that is giving us wholesale credit, that is an interest rate buy down, or concessional debt. And then on the top layer, you have a commercial investor or a bank. How we got there is we started with savings group, and we layered on top of it things that made our pipeline investable, a subset of it. Yeah.
Very, very, very interesting. Thank you so much. And yeah, it shows, when you start a bit with innovative finance, you start step by step, and after you actually are so well versed into all the structures. And actually, what is interesting is that when you start to manage the tools, you can innovate and innovate and innovate. So very impressive to learn all the use cases. And actually, because you mentioned you have some, we can deep dive into some of the case studies or some of the examples that you have done. You mentioned supply chain, or if you want to choose something else a bit closer to entrepreneurs, but maybe if there were one example which could be quite relevant for, I know it's always a tricky question. Sorry for this.
I will give two, because I think, there might be nonprofits in the room, and I think it's important to explain how do we play in this space, right? Because for many nonprofits, there are a few nonprofits that will spin off a fund. Mercy Corps has one, Save the Children has one. In my role, I do not manage a fund. However, my team is often having conversations about complex structures that involve funds, right? And so I'd like to give two examples of how does a nonprofit play in this space. The first one I'll give is a development impact bond. I saw the question in the chat about risk. So let me give that example, right? So in Ethiopia, and I should put a link in the chat, and it might be actually that Human Planet worked with us on this. It might be that COIS helped us structure this one. In Ethiopia, we were doing work on menstrual health and hygiene. Right? So, you have girls who are, trying to figure out, in puberty, are trying to figure out this really tricky thing. What's a safe place where I can change, where I can have conversations about how my body is changing, etc. And who was invested in driving results here was AFD, right? The French Agency for Development, saying, we've been throwing money at this problem for a long time, educate, no changes. This is a multidimensional problem. We need spaces where they can change. We need education. We need their parents to be involved, all these pieces together, conversations in the community. And so the structure we came up with was, I think it was BNP Paribas, commercial investor, funded the working capital. So we listed, these are a bunch of activities that we need to do to drive certain results. Results equals girls being retained in school, not dropping out because of menstrual, whatever. And I think there were also some results that were maybe output level. We've had this number of conversations, blah, blah, blah. So we specified those. BNP Paribas, a commercial investor, funded the working capital for the activities, right? And then there was an independent evaluator that tracked over time how many girls stayed in school in these communities, how many conversations happened in the community, how many things were constructed. When those were validated, then the French agency repaid the working capital, and then the NGO Care also got a premium, right, for achieving the results. You had a bonus. So in the end, first of all, in the entire structure, we carried no risk. The way it was structured, it was if this fails, BNP Paribas loses money, right? So I'm just saying the truth of the matter is if you're there involved upfront in design, in the end, this is about who bears risk, who bears return. You can have a conversation about this is our risk appetite, right? So we're great at delivery, we can bring the community together. And I think there's a legitimate case, it's a case I make across our work, that we should be paid for the access we give to really hard to reach communities and to de-risk those communities and to drive results, right? It will not always be like this, but we bear no risk. The second example I will give you is actually live now, Pipeline. So an investor heard me speak in Foundation House. They hold 80 million or so from the National Development Bank in a Latin American country, entirely debt, commercial debt. And they are taking on a new project. It's called agrivoltaics. So it's really interesting. Dual use. You have land, and on the bottom of the land, you have to plant things that grow in shade, because on top of it you put solar panels. So instead of putting the solar panels close to the land, there's a space that allows for dual use, right? And so they need access to land, and they need access to farmers, and farmers that will shift production to lettuce and grapes and all the things that can grow under that thing, and then will make use of solar powered assets, right? That generate revenue, that that payments that return to the investor, right? Look who has farmers, right? So my footprint is 30 million strong globally. Just in the country that they're in, I think we have 200,000 farmers. So, we then start a conversation about what is needed to get there. You need us to, aggregate these farmers. You need us to, help them convert their production. You need us to connect them to off-takers, access capital for solar asset financing, all those things. And then we need, because they're going to access capital, solar asset financing, we need grant financed, de-risking tools there. So a guarantee or something. So we structured something where they're at the top with their commercial debt, we're at the bottom with our catalytic TA and our, guarantees, and they're paying for everything, right? So they're grant financing me to do this really interesting work. I am not holding any debt, and we're participating in what I think is a very interesting structure. Why is this important for CARE? I think the results we're driving are really important, right? So I think this benefits the farmers in terms of income. It benefits them in terms of access to markets. It benefits them in terms of using solar assets. It benefits them in terms of over time, the assets on their land transfers to them. So when we're helping negotiate that as well, it benefits CARE because we're in an environment where funding is really difficult, right? Ordinarily, how would we do something like this? We'd go to USAID and say, oh, we have this really interesting project. And then over time, we'd put in a bid. There just isn't that money anymore, right? So we get a chance to do the work that we do, funded through a different means. When we think through very carefully what risk can we bear, who can fund our work, who is interested in what we have to offer, which is a massive footprint in the community, a lot of trust in this community, a very structured way for segmenting. Okay, this is a farmer, this is not a farmer, this person is capital ready, that's not. So really knowing them really well in an auditable way, because it's digitized in some cases and you can see the track record. It's not I'm saying, you can look at it, right? And say, okay, this is who this person is. That's why we can play in this space in this way. And I think it's a door that a lot of other nonprofits should be opening.
Very interesting. No, it's very interesting. All the examples and also the innovation and there is no limit actually. You can try as many things as long as you find investors also to share the risk.
That's true. Indeed.
Which is always the tricky part.
Yeah.
So I think we are almost at time. I want to still keep a few minutes for the audience to keep ask questions. But there was one question I had for you. So again, like Sabrine asked Rui, kind of a 1 minute answer. Even it's difficult. So because you mentioned also there might be some small organizations in the audience, small NGOs, entrepreneurs, social enterprises, and it's CARE, you are quite very advanced. So if you had some advice for smaller organizations to take the first step to start to diversify their access to funding and starting innovative finance, where you would start?
I would start by saying, there are all these interesting grant finance, blended finance tools. Like just telling an investor, I'm willing to stake my work on results versus activities, I think is compelling, right? So, I think results-based financing is like the low-hanging fruit here. It's that you do what you do, but you believe so strongly in the results you drive that you can articulate what those are and say, pay me when I deliver on them, and we'll find someone else. The outcome funder doesn't have to be the working capital funder. Someone else who covers my costs, some way to cover my costs, pay me for results. I feel like the low-hanging fruit for nonprofits with our risk appetite keeps our grant finance is results-based financing. I think everyone should in this constrained environment where funders are asking, am I throwing money away? I think that's something that gets you in the door is, pay me for results. And then you find someone else that funds the working capital. So that's the thing I would recommend for nonprofits is everyone should be trying that. I think the first results-based financing project I led was a decade ago. So this is an old tool. It's tried and tested. You have so many examples to draw on like all the ways you can structure it and who might be willing to pay for your working capital. So yes, I would recommend that to everyone.
Great. Thank you so much, Adana. It was very, very insightful. Thank you so much. It was great to have you today, you and Rui, actually. I think we will actually open the floor. We'll still need you for a few minutes because there might be some questions for you. So we'll open the floor to Q&A. Jonathan, are you here?
Yes, Cedric, I'm here. Good. So again, as always, just head over to the Q&A and leave your questions. We have a couple of few questions. And we'll take this one first. Please give an example of how an education project results yield ROI for investor. I think this one is for you, Sandrine.
Sorry, can you hear? Okay, yes. So, for example, it depends on the structure that you use, right? So, if it's for outcome-based investors, number of beneficiaries that you've identified, right, who are educated for a certain project, the communities that are impacted, or what the scale of the capability shift has been in terms of that project. So essentially, it should be conversation based. So you as an organization, the project that you have, what is the delta that you are filling from point A to point B? That should be articulated to the investors. And that will then trigger payments, right? Depending on the structure that's used. So education is a broad subject. It could be such a variety of metrics, but they just have to be pre-approved and pre-agreed to be considered as what the investor would classify as their return. Every investor is very, very different as well. So Rui had a great example on the education entity that he's an investor in, who helps build capability in markets. And corporations are also investing in it. So corporations have a very different ROI to the private investors, right? So ROI is a very, very different and sliding scale depending on the investor base that you're working with.
Sabrin, maybe just very quickly, I can comment on that particular case.
Sure.
The way it was structured was that the corporates that were willing to pay for those results have set certain targets, especially on average improvement in the grades around STEM, because obviously there was kind of the core that they could identify that generally would impact their businesses. And then the company, which developed an IP in education, went on to find private investors that were willing to, finance the setup, obviously all the OPEX, etc., for the business to start building that track record. That eventually, with track record, became commercialized with those corporates that have provided the guidelines, I guess, in terms of what results they wanted ultimately. And the model is working, so the corporates eventually start paying for those results, and at some point investors will be repaid. So yeah, in that case was delta in the grades around STEM in particular, not only but mostly.
Wonderful.
Good,
Thanks
you
for helping.
So another question here. So it's two questions. We'll start with this one is for you, Adina. Did farmers get access to the electricity produced? So this is for you, and it's another follow-up question for this one. Foreign Martin's question in the chat, is all the revenue from the solar panel going back to the investor, or it is also shared with the farmers in cash back and with the care economy continue to expand activities? This is for you, Dina.
Both questions. So yes, I don't know, maybe perhaps in speaking fast, I had, skipped over that. Within this sort of structure, we aim for farmers to be able to use the solar power to power, things related to their business, right? So think solar powered irrigation, for example, or some farmers are exploring solar power refrigerators for storage. So they do have access to the electricity upfront. Now, over time, they will gain access to the assets, right? So that is what we're negotiating. In the beginning, cash is going to flow to the investor until they reach a certain hurdle. And then there will be a split in income. Certain percentage will go to the farmers. These are the details now. Huh? Will go to the farmers and certain percentage to the investors until there is full repayment of principal and some level of return. That's what we agreed upon. And so yes, there is return for the farmers in addition to the investor. And then I wanted to note, the World Bank has a very long history of doing education results-based financing. So if you want to look at examples, paying, for student attendance, paying for learning outcomes, which is much harder, just Google World Bank education results-based financing, and you'll probably be overwhelmed with examples.
This is another question, Samir. I think this one is for you and it's quite long. In the blended finance model has shown on the three-tier slide, the higher tier is looking for market returns. Is this realistic as we move into a world limited by planetary stress and where capital could fund SMEs that can create significant local economics benefit, but might not scale in the way capital has enabled unsustainable scaling in the part? So I guess the question here is that does impact investing ultimately need to lead to investors accepting lower returns in return for greater long-term sustainability and equity? Sambray?
I think in an ideal world, of course, but we all live, a very different reality, and I don't think that's going to happen, right? And I'm being very, very honest here. And both Rui and I come from both the commercial capital sort of world and commercial banking world, and we've moved into the impact space. Change is coming, but market returns are critical if we want to deploy at scale, and if we want to continue attracting commercial capital. So those forms of capital that will accept lower returns will invest in riskier or sort of early stage solutions that address some of these issues, these critical issues are always there. But if we want to 10x that, we have to crowd in commercial capital. And for that, that's why the way you structure a blended finance vehicle is incredibly important, because you can have the best of both worlds and each bring in their own skill sets or their own unique viewpoints, right? That helps a project or an organization to scale. Rui, do you have anything to add? Because I know you touched upon it a little as well.
No, I fully agree. I think, in fact, the only comment I would make is that what we've been seeing lately is that innovation tries to beat existing solutions at efficiency levels, and with technology that is now more and more possible. So what commercial investors are looking for in impact investing is actually new solutions that not only are impactful and at the core thinking about people and planet, but also there are better solutions overall than the previously existing ones. And technology is a great example. Obviously, there's creativity to do in many different ways. But otherwise, you wouldn't have the scale that you need. And again, to the point I made earlier, we need to shift the capital allocation of the large players to make a difference. So until we can see that happening, of course, it's great. And in some causes, you have family offices, high net worth individuals and the likes putting their money to support these causes. To have a significant shift around the world, we need to start bringing the large investors.
Thank you, Rui. We have a couple of questions, but we cannot take all of them today. We have already gone 4 minutes above the time. So, Cedric, I'll turn this over to you. We'll stop the
Yeah.
Q&A and we'll move everything to the next session, which is happening tomorrow. Cedric, over to you.
Thank you so much. Big thank you for you, Adana and Rui, for having shared all these insights. It's very is great, and I saw the the number of attendees, which was actually increasing when you were speaking. So usually it's the opposite, so it's great. We also have a lot of questions, and I'm receiving actually in parallel some demands for meetings, for consultations. So I think this was the way we see that in the audience there is interest for innovative finance. So quickly. Yes, so we have the third session and the last session, which is tomorrow, where we'll deep dive actually around, which was one of the questions around investment readiness. What makes an investment more like kind of market fit? What are the best practice? And this will be the last one. Before we end, I'm sharing one more time the consultation QR code. If anyone wants to have a meeting with us, with the team, I will receive the invites. I will share with the team, and even if you want to test some assumptions that you have on your project, and the link also to apply. Perfect. So thank you so much, everyone. Again, it was a great, very insightful discussions, and we will have the next session tomorrow. And again, big applause for Adana and Rui for having joined us, and big thank you to you, Sabrine, also for having collated this webinar.
Thanks for
Thank you
having
so much.
us.
It was a pleasure.
Thank you,
Thank
Cedric.
Bye.
Thank you all.
Thanks to our
Take care. Bye.
community for joining us. Bye.
Thank you.
Ciao, bye-bye.